Hey everyone, and welcome back to another Market Explainer. If you've been glancing at the charts recently, you might feel like everything is moving in a dozen different directions at once. But today, we're exploring a seriously fascinating story unfolding in the data. We're going to see how a single, powerful macroeconomic factor is practically driving the entire global market right now. Get ready because we are mapping out the ultimate domino effect. Okay, let's dive right into this. Can one single currency genuinely hold the reins of the entire global financial system? It sounds kind of wild, right? Dictating the moves of everything from stocks and commodities to digital assets? Well, as we unpack the data from the past week, we're going to see that the US dollar is the undeniable hub of this week's financial movements. Basically, every major shift we've seen is just a spoke radiating out from the immense gravity of the USD. So here's how we're going to map out this domino effect today. We'll start with the big picture, look at the USD returning to center stage, check out why commodities are fluctuating wildly, see how equities still attract money, touch on why crypto remains highly risky, and wrap it all up with our bottom line, USD strength. All right, part one, the big picture. To really get a grip on what happened this week, we have to zoom out a bit. Believe it or not, if you look at the raw data, exactly two major forces dictated the entire rhythm of the global market this week. Just two. Everything else was secondary. So what were these twin drivers? Well, first up, the Federal Reserve maintained a pretty hawkish stance following their June meeting. That essentially laid the fundamental groundwork for the US dollar's strength, signaling to everyone that high rates aren't going anywhere fast. Secondly, we saw a notable cooling of tensions in the Middle East, specifically driven by some progress in US-Iran talks. That development instantly boosted global risk appetite and took some serious immediate pressure off the energy sector. These two pillars, sticky rates and cooling geopolitics, are the exact lenses through which we need to view the rest of this explainer. Which brings us to section 2, USD returns to center stage. Now, what's really interesting here is the sheer momentum of this rebound. After a brief period of weakness, cash just came flooding back into the USD, with the DXY surging brilliantly from under the 100-point mark to a 1.45% jump at its peak. And this was no accident. It was fueled heavily by expectations that the Fed is going to hold interest rates higher for longer, totally abandoning any rush to loosen policy. Add in Fed Chair Kevin Warsh striking a really cautious tone on inflation, leaving the door wide open for further tightening if necessary, and boom, the dollar had all the fundamental rocket fuel it needed to take off. And you know what the direct consequence of that strong USD is? Crushing pressure on other major currencies. Notice the stark divide here. On one side, the USD/JPY pair is skyrocketing to around 161.3. Why? Because the yield gap is massively favoring the dollar. Even though the Japanese government initiated some rate hikes, the yen just isn't strong enough to reverse this long-term trend. On the flip side, both the euro and the British pound took significant hits against the dollar, dropping anywhere from 1.6 to 2%. The European Central Bank simply hasn't generated enough momentum to compete with the gravitational pull of the Fed right now. Moving on to section 3, commodities fluctuate wildly. And once again, it all comes back to the USD. Let this number sink in for a second. -6 to -7%. That is a literally massive, sudden plunge. And it's exactly what we witnessed in both Brent and WTI crude oil during some sessions this week. Just look at the sharp cliff in crude oil WTI. Prices literally plummeted into that $73 to $76 per barrel range before finally catching some late week support. Remember that second macro driver we just talked about? The US-Iran talks? Yep, that was the trigger here. The prospect of resuming oil flows through the Strait of Hormuz drastically eased those global energy inflation fears. The market immediately priced in this lower geopolitical risk, leading to this dramatic drop. But hey, oil wasn't the only commodity experiencing major turbulence. We also saw a really striking pullback of nearly 5.8% in another massive safe haven. And that safe haven is gold. Gold actually had a fairly volatile week. Early on, it saw some really decent defensive demand, holding up at high price levels, but man, it completely lost its legs after the FOMC meeting, falling sharply down to around the 4,156 USD per ounce mark. The pressure here is entirely predictable. It's the rising yields and hawkish Fed pumping up the US dollar. While gold is still fundamentally supported by a baseline need for defensive assets, the sheer undeniable strength of the USD is basically acting like a lead ceiling, severely capping any major upside rally. All right, on to section 4. Equities still attract money. So despite this super resilient USD and the strict Fed policy backdrop we've been tracking, stocks are throwing us an undeniable paradox. Look at this massive figure, 55 billion USD. In spite of all the interest rate anxieties, global equity funds pulled in over $55 billion. That's a 19-month high for global equity inflows. And get this, out of that massive pie, nearly $38 billion went straight into the US market alone. So why on earth is money rushing in when rates are so high? Well, it's all about the narrative, right? Major indices like the NASDAQ are staying positive and hovering right at historic peaks. Investors are practically plugging their ears, ignoring the rate fears to chase the incredible boom in technology and artificial intelligence. The S&P 500 and the NASDAQ 100 are being heavily elevated by these super strong future-facing growth stories. People simply aren't ready to abandon risk assets yet, even with a hawkish Fed. But actually, scratch that. The rally isn't bulletproof. So the crucial point is this. While tech is flying high, warning signs are definitely flashing elsewhere. The Dow Jones created a historic peak, but was firmly rejected, dropping 1.7% by the end of the week to settle around 51,400 points. This rejection at the very top is a classic technical signal hinting at a deeper correction on the horizon. The market is super hot for sure, but it is certainly not without friction under the hood. Next up, section 5. Crypto remains highly risky. Now, keeping our thematic focus alive, because let's face it, the crypto space is proving heavily dependent on US monetary policy right now. If you've been checking your crypto portfolio this week, you might be asking this exact question. Why is the market just moving sideways? Bitcoin has been doing this slow accumulation, hovering around the 64,300 USD mark after that rapid drop earlier in the month. Meanwhile, altcoins are severely underperforming Bitcoin, with money being extremely selective. We are certainly not seeing any signs of a broad altcoin season. So what's missing? The answer, straight from the analysis, is that the market needs a new catalyst. Right now, the crypto space lacks a strong, independent narrative of its own. It's essentially adrift, at the absolute mercy of global risk appetite and U.S. monetary policy. Without a unique driving force, crypto is just sitting on the sidelines, waiting to see what the Fed, and by extension, the U.S. dollar, does next. Which brings us to our final section, Section 6, Bottom Line, USD Strength. We have covered a ton of ground today, traveling from the heights of the NASDAQ to the dips in oil and that sidewise grind of Bitcoin. Let's tack all these dominoes back to the starting point. If there is a single defining theme you need to take away from this explainer, it is the absolute, undeniable power of the US dollar right now. As long as the Fed maintains its hawkish stance and the market doesn't anticipate early rate cuts, the USD is guaranteed to remain the lead asset. It is actively dictating the rules for the whole shebang. It pressures the euro and the pound, it favors pairs like USD CHF, it actively limits the upside potential of gold, and it acts as the master switch for both crypto and equities, which remain heavily dependent on US rate expectations. The dollar is setting the floor, and it is setting the ceiling. Which leads us to our final and perhaps most important question of the day. With the US dollar asserting such dominant control over the global financial ecosystem, is your portfolio ready? Are your investments positioned to weather this specific macroeconomic gravity? It's a critical question to ponder as we head into the coming weeks. Thank you so much for joining me for this market analysis. I really hope this structured look at the data has brought you some real clarity today. Keep learning, stay focused, and I'll catch you in the next explainer.